You've heard it your whole life. Buy a house, build equity. It's the best investment you'll ever make. Your parents said it. Their parents said it. Every financial advisor, every real estate agent, every well-meaning uncle at Thanksgiving, they all say the same thing. And here's what's wild. They might be wrong. Not completely, not always. But the story you've been told about home ownership and wealth building has some serious holes in it. And today, we're going to rip it apart, piece by piece, and then put it back together so you actually understand what you're getting into when you sign on that dotted line. Welcome to Better Investments. Let's start with a story. Two friends, call them Alex and Jordan. Same age, same income, both around 30. Alex buys a house. Jordan keeps renting and invests the difference. 20 years later, who's wealthier? Most people instinctively say Alex, the homeowner, because that's the cultural script we've been handed. But the real answer? It depends on a dozen variables. And by the end of this video, you're going to know exactly what those variables are and how to figure out which answer is right for you. First, let's talk about why the houses are a great investment myth is so sticky. In America especially, home ownership is baked into the idea of success. It's the picket fence, it's stability, it's something real you can touch, drive past, and say, that's mine. And emotionally, that means something. We're not dismissing that. But emotion and return on investment are two very different conversations. So let's have the money conversation, and let's be brutally honest. Here's the first thing that's going to surprise you. Over the long run, home values in the United States have barely beaten inflation. Yale economist Robert Shiller, Nobel Prize winner, one of the smartest people to ever study this, tracked US home prices going back over 100 years. His conclusion? After adjusting for inflation, real home prices rose by about 0.6% per year on average. 0.6%. For comparison, the S&P 500, just a basic index of American stocks, has returned roughly 7% per year after inflation over the same general time frame. Now, before you shut this video off and call your real estate agent to yell at them, hold on. Because this number alone is misleading, and real estate has a card up its sleeve that stock market returns don't. Leverage. Here's what leverage means in plain English. When you buy a $400,000 house, you don't usually put $400,000 down. You put maybe $80,000 down. That's 20%. The bank covers the rest. But here's the thing. When that house goes up in value, the entire house goes up. Not just your $80,000, the whole $400,000. So if that home goes from $400,000 to $500,000, that's a $100,000 gain on an $80,000 investment. That's a 125% return. That's the power of leverage, and it's real. But, and this is a big but, leverage cuts both ways. If that same house drops to $320,000, you just lost $80,000. Your entire down payment wiped out. We saw this happen to millions of families in 2008. People who did everything right, bought in good neighborhoods, made their payments, still watched their net worth crater because leverage amplified the loss just as hard as it amplifies the gain. So step one of understanding home investment. Appreciation is real, but it's slower than you've been told. And leverage is the actual engine, with all the risk that comes with it. Now let's talk about the stuff that gets buried in the fine print. When people tell you their house went up $200,000 in value, they almost never subtract what it cost them to own it. And that number is shockingly large. Let's go through it. Property taxes. The average American pays around 1.1% of their home's value every year in property taxes. On a $400,000 home, that's $4,400 a year. Every year. Whether the market is up or down. Whether you're using the house or not. Insurance. Homeowners insurance typically runs $1,500 to $3,000 a year, depending on where you live. And if you're in a flood zone, a hurricane corridor, or God help you, California wildfire territory, that number gets ugly fast. Some people are being quoted $10,000, $15,000 a year now. Entire neighborhoods are becoming uninsurable. That's not hypothetical. It's happening right now. Maintenance. The classic rule of thumb is 1% of the home's value per year in maintenance. Some financial planners say 2%. On a $400,000 house, that's $4,000 to $8,000 annually. New roof every 20 to 25 years. $15,000 to $30,000. HVAC system. $5,000 to $12,000. Water heater, plumbing, electrical. It adds up fast. And it's always on your dime when you own. Mortgage interest. This is the big one that people don't think clearly about. When you take out a 30-year mortgage, especially in the early years, almost everything you pay goes to interest, not principal. On a $320,000 loan at 7%, which is roughly where rates have been lately, you'd pay over $440,000 in interest over the life of the loan. You borrow $320,000. You pay back $760,000. The house needs to go up by a lot just to break even on that. And then there's closing costs. Buying and selling a home costs money every single time. Buying, 2 to 5% of the purchase price. Selling, realtor commissions alone are typically 5 to 6%, though that's shifting after recent legal changes. Transaction costs on a $400,000 home round trip can easily hit $30,000 to $40,000. If you sell too soon, those costs eat your gains alive. So what's the total damage? If you own a $400,000 home for 10 years and factor in taxes, insurance, maintenance, interest, and transaction costs, you could easily spend $150,000 to $200,000 in ownership costs. That's money that did not build wealth. It just kept the lights on and the roof over your head, which, to be fair, you needed somewhere to live anyway. And that's where it gets interesting. Renting is throwing money away. You've heard this. Maybe you've said it. Let's kill this myth right now, because it's one of the most financially damaging things people believe. When you rent, yes, you pay money and don't own anything at the end. True. But when you pay mortgage interest, same thing. You're paying a bank. When you pay property taxes, paying the government. Insurance? Gone. Maintenance? Gone. These are all costs with zero equity return. The real question isn't rent versus own, it's what do you do with the difference? If you'd buy a home for $3,200 a month all in, but can rent a comparable place for $2,200 a month, that $1,000 difference invested every month in a diversified index fund, could grow to over $200,000 in 15 years, assuming historical average returns. That's real money. That's a retirement account. That's a down payment on a future home when the time is right. Renting isn't failure. Renting in the right situation, with the right financial discipline, is a completely legitimate strategy. Now let's flip it, because buying a home can be a fantastic financial decision. Here's when. Number 1, you're staying put. This is the single biggest factor. If you buy and sell within 3 to 5 years, the transaction costs almost always wipe out any appreciation you gained. The math on home ownership really starts to work when you're in it for 7, 10, 15 years or more. If there's any chance you're moving in 5 years, job change, relationship change, city change, renting is probably smarter. Number 2, you're in a market with strong fundamentals. Not all real estate is equal. A home in Austin, Texas in 2015 was a completely different bet than a home in rural Ohio in 2015. Population growth, job markets, infrastructure investment, school districts. These drive real demand, and demand drives appreciation. Buying in a market with strong fundamentals dramatically changes the investment math. Number 3, you lock in a fixed housing cost. Here's something renters don't get: certainty. If you get a 30-year fixed-rate mortgage, your principal and interest payment never changes. Your landlord can raise your rent every year. In high-inflation environments, owning a fixed-rate mortgage is a huge advantage. You're essentially paying back the bank with dollars that are worth less and less over time. Number 4, the forced savings effect. This one's psychological but powerful. Every month, your mortgage payment builds equity. Slowly at first, then faster. For people who struggle to save and invest, home ownership acts as an automatic, forced savings program. It's not the most efficient vehicle, but it works. And for millions of Americans, their home is the only significant asset they ever accumulate. That's not nothing. Number 5, tax advantages, though these are smaller than they used to be. The mortgage interest deduction still exists, but changes over the last decade made it less impactful for most people. You can deduct interest on up to $750,000 of mortgage debt. And if you sell your primary home, you can exclude up to $250,000 in capital gains from taxes. $500,000 for married couples. For people sitting on massive gains, that exclusion is genuinely valuable. We can't talk about houses as an investment without addressing the elephant in the room. Home prices went insane between 2020 and 2022. Pandemic migration, low interest rates, remote work, constrained supply. Everything hit at once, and homes in many markets appreciated 30%, 40%, even 50% in 2 years. And then interest rates went up. Fast. The Fed raised rates at the quickest pace in 40 years. And suddenly mortgages that were at 3% in 2021 were at 7.5, even 8% by late 2023. What does that do? Take that $400 house. At 3%, A 30-year mortgage on $320,000 costs about $1,350 a month in principal and interest. At 7%, that same loan costs $2,129 a month. Same house, same loan amount, $780 more every single month. Affordability cratered. And yet prices in many markets didn't fall dramatically because homeowners with 3% mortgages weren't selling. Why would you give up a 3% mortgage to buy something new at 7%? This created a frozen market with high prices and high rates. For buyers, that's the worst of both worlds. Is this permanent? Probably not. Rates will likely moderate over time. Inventory will eventually loosen. But the idea that now is always a great time to buy real estate is sales talk, not financial analysis. Timing matters. Context matters. Okay, we've gone through a lot. Let's bring it down to something practical. Before you decide whether buying a home is the right investment for you, run through these 5 questions. 1. How long will I stay? Less than 5 years, lean toward renting unless you have a very strong case. 5 to 10 years, evaluate carefully. 10 or more, buying starts to make a lot more sense. 2. What's the price to rent ratio in my market? Divide the purchase price of a home by the annual rent for a comparable property. Under 15, buying tends to make financial sense. 15 to 20, it's a toss-up. Over 20, renting is often cheaper when you run the full math. In cities like New York, San Francisco, Miami, ratios of 30, 35, even 40 are common. In many Midwest and Southern cities, ratios of 12 to 16 make buying much more attractive. 3. Can I comfortably afford it? Not stretch afford. Not, I'll make it work. Comfortably. The traditional guidance is no more than 28 to 30% of gross income on housing costs. Going well above that because you're house hungry is how people end up house poor, asset rich, cash poor, and miserable. 4. Do I have a strong emergency fund? Before you buy, you need cash reserves beyond your down payment. Homeownership comes with surprise expenses. HVAC fails in August. Roof leaks in November. If your down payment wipes you out, you're one broken water heater away from credit card debt. 5. What's my alternative? If you don't buy, what do you do with that down payment and the monthly difference? If the honest answer is, it sits in a savings account, or I'll spend it, the forced savings effect of home ownership might be worth its inefficiencies. If you're genuinely disciplined and would invest it, that changes the comparison entirely. So, is buying a house a good investment? Here's the honest answer. It can be, but it's not automatically one. It's a good investment when you stay long-term, buy in a market with real demand, get a rate that makes the payments manageable, and account for the full cost of ownership. It's a questionable investment when you're buying because you feel like you should, when the price-to-rent ratio in your area is punishing, when you're stretching your finances to the limit, or when you might move in a few years. What it always is, and this is important, is a place to live. A home isn't just a financial instrument. Stability, community, the ability to paint your walls whatever color you want. Those things have real value that doesn't show up in a spreadsheet. The mistake isn't buying a house. The mistake is buying a house with your eyes closed, believing the myth that it's automatically the greatest wealth-building tool ever invented, without understanding the math behind it. Now you understand the math. Make the decision that's right for your life, your timeline, and your financial situation. Next time on Better Investments, we're tackling something that even more people have strong opinions about and even less actual knowledge of: the stock market. Is it gambling? Is it a wealth machine? Is it both? We'll get into it. Hit subscribe so you don't miss it. And if this video saved you from making a $400,000 mistake or helped you feel confident about making one, share it with someone who needs to hear it. I'll see you next time.